Even though we spent a lot of time in the last section talking about mortgages and notes, typically that's all from the private sector. The government doesn't get involved a lot in mortgages per se. Even though a bank is federally chartered and backed by the government usually doesn't get involved. However, there are several times where the government may back or insure a loan, which is what you guys probably typically call an FHA loan. The thing you need to understand right away is there is no such thing as an FHA loan. There's no such thing as a VA loan. Those entities do not make loans. They are backed by FHA or they're insured by the VA, but as a rule, they don't make loans, okay? So we're going to today talk about the difference between the primary and the secondary market, how this really plays out. Do I still have my note and stuff? Yeah. The primary and secondary market. We're also going to talk about the impact that the government does have on those and how they can control them to an extent. And then we're going to talk about the difference between what we have been talking about, this thing called a conventional loan, and some of the government insured and backed loans and how they play and some of the rules they have. Okay? So let's get started there on page 234 and talk about how the government can actually control money, first of all. The government can control the flow of money, and they do this all the time. They do it in only two methods, okay? The first method is called the Fed rate. The Fed rate. The Fed rate, or I'm sorry, discount rate. They call it the discount rate. It's the federal funds discount rate. This is the money that banks charge other banks interest. All right? We as private people don't go to a Federal Reserve Bank and borrow money. Banks do. When banks need a quick infusion of cash, they're going to go to the bank. If you watched Too Big to Fail, they call it going to the window. They're going to go, so a bank will borrow money, because remember I told you the other day, banks don't have money. Well, when they get low or they want to increase some of their lending procedures, they will borrow money from the Federal Reserve. There are 12 Federal Reserves throughout the United States. Indiana works on Federal Reserve number 5 out of Chicago. Number 1 is New York, and that used to be, what was his name, Tim Geithner. I don't know who it is right now. Do you know who that is? Gosh, I should know that. So when they raise the discount rate, what are they trying to do to the economy? They're trying to slow it down, right? If they raise the cost of money, they are expecting less money to be borrowed, so they are trying to slow down the economy. Right now, here at the end of 2018, this has happened 2 or 3 times in this year where they've raised this rate. All right? So that's how they control money, through the discount rate. They either raise it or they lower it, depending on what they feel the outcome or the outlook of the economy is going to be. The second way that they can influence markets is through this thing called the reserve requirement. A reserve requirement is the requirement that they place on banks that banks must keep a certain amount of money in their vault for every dollar they loan out. In case something goes wrong, they have money to cover it. All right? Currently, the reserve requirement is 10%. And it's been 10% for a long, long time. So the other way of looking at this is banks can lend out 10 times the amount of money they take in. So now you understand why you see a lot of here lately in the last 10 years, 5 years, banks having commercials about trying to draw you into their bank. Because what happens is you go in on payday and you put your $1,000 paycheck in there as, hey, I want to put it in the bank. That bank can now loan out 10 grand. Because if they keep 1,000 on hand, they can loan out 10 grand. So there is why they're now trying to get you guys as consumers, because they realize, oh yeah, we can put money in our bank and loan it out to people that need cars or home improvement loans or purchases or anything like that. So typically, that's the only two ways the feds control money. They do it through a discount rate and they do it through a reserve requirement. And the same thing's true with both of them. If they up the reserve requirement, they're trying to slow it down. If they up the discount rate, they're trying to slow it down. Those are the two methods that the government can use to influence the economy during a recession or inflation. Now, when it comes to mortgages, there are two markets that we talk about. And now we're getting a little more in depth because I told you banks have no money. So they get money from investors. These are the guys that put money in their pocket, hand in their pocket. Yeah, they put money in their pockets too, but they put their hand in their pocket and pull the money out. They are called the primary mortgage market. The primary mortgage market. These overheads are switched backwards, because there's the discount rate and the reserve requirement talking about it there. Here's the primary mortgage market. Now, in your book or on the overhead, there's some people there that are considered the primary mortgage market. Savings associations, commercial banks, insurance companies, credit union, pension funds, investment group, mortgage brokers. What do all of those people have in common? What do all of those people have in common? They all have more money than they know what to do with. Literally. People pay their union dues every day. People pay their insurance premiums every day. People join credit unions. So these guys literally get money every day. There was a really cool movie several years ago called Blow with Johnny Depp, where it was about the cartel family. And in the one scene, Johnny Depp comes into the house and he's holding all the $100 bills bundled in a plastic cube. And it shows him set it on the kitchen counter. And then it shows this montage of him going in and out of the airport and back and forth and up and down and all that. And then it cuts to him again walking in the house with a cube of money that's saran wrapped together. And as he walks through the house, every flat surface in the house is covered with cubes of money. There's nowhere for him to put it. So he literally, in the movie, walks in and sets it on the back of the toilet seat, because that's the last place. I mean, the beds are all covered with money. The kitchen counters are covered with money. The kitchen tables covered with money. That's who these guys are. They have that much money that they don't really know, can't do anything with it. So what they end up doing is they give it to banks as an investor and say, loan our money out. They become the primary mortgage market. When you go get a loan from a bank and you get that $100,000 that we showed you in last session, and they loan that out, they loan that, it's BlackRock's money. It's Teachers Credit Union. It's, one of the insurance companies. It's the Jed Clampetts of the world that give it to the bank. So when the bank loans out that $100,000 to you, it's their money they're loaning out. And then you sign this IOU, which says you're going to give me back $554 a month for the next 360 months. And then I make you sign this mortgage. That's the collateral that goes behind it. So what I have as the bank now is I've got this IOU and I've got this mortgage that are together. But here's the problem. My investor doesn't want to wait 360 months to get his money back. He wants his money back now with some interest that I promised him. So what you see are these what they call secondary mortgage market. So what ends up happening is this. The bank takes this $100,000 IOU, which is really worth how much now because of the interest rate? It's worth $200,000 over the next 30 years. So what they do is they go to somebody called the secondary mortgage market, which the big ones that you guys know are Fannie Mae, Freddie Mac, Bernie Mac, Chili Mac, Big Mac, all of those guys. All right? And they say, hey, look, I've got this piece of paper that's worth $200,000 over the next 30 years. Would you pay me $150,000 for it right now? And they say, well, yeah, that's a deal. I'll pay you $150,000 today. I'm going to get back $200,000 over the next 30 years. I will buy that from you. So remember, these are negotiable. Sell the note to the secondary market. But the secondary market also wants the collateral or the bite, as we talked about, to go with it. So they assign the mortgage to the secondary market, and the bank says, we're out. Now we've got our money back. We give Clampett back his money, plus the interest, plus we made a little bit of money. That's how this whole process works. They loan the lender's money out. They get an IOU. They turn around and sell that on the secondary market, get their money back, give Clampett back his interest, and do it again. And that's all they do. That's called financial services, which is about 20% or about 70% of our gross national product. They just move paper around. Our econ teacher at A&M told a story. It's very interesting, and I can't remember exactly how it went, but it's basically like this. Guy walks into a hotel and says, I want to rent a room. Here's the $100. I'm going to go upstairs and take a peek at the room to make sure I like it. So he goes upstairs. In the meantime, the owner of the hotel says, oh, I'll take that 100, and I got to pay my wholesalers for all the food I buy, so he gives it to the wholesaler. The wholesaler says, oh, I've got to pay a friend of mine, so he gives it to her, and she said, oh, I work at the hotel, finger quotes. I owe the hotel money. She comes back and puts the $100 back on the hotel's desk. The guy comes down from downstairs and says, you know, I've decided I'm not going to rent that. So he picks up the $100 and walks back out. No money changed hands. Everybody got paid. $100 bill, still where it started, but it made this big circle around where everybody got paid. It was a real long, much longer story, and he did the wholesalers to the suppliers, to the owners, to the, all the, down the whole thing. But virtually that's how it turns out, that the guy ended up with the same $100 bill, but yet everybody was paid along that route. So that's what they're doing, is just moving money around. Loans are bought and sold daily. You guys can buy loans. There is no law that says you cannot. If you've got money, you can go out and buy the secondary, be a buyer on the secondary market. There's websites out there. There's performing loans, there's non-performing loans. You can get personal loans. You can buy stuff from Rent-A-Center, all of that. It's all what you want to do, but they're all out there. The big ones that we all think about are Ginnie Mae, Freddie Mac, Fannie Mae, and then there's one called Farmer Mac, which we're going to get to, the USDA loan. Those are the big government-sponsored entities they call GSEs. but there's no law that says you can't do it as well. All right? Let's change audio.